Have you ever heard those wild stories? Traders on Wall Street making a fortune overnight with options? Or maybe you've heard about startup employees who became millionaires because of their stock options? It's the same term, right? Stock options. But are they actually talking about the same thing? Well, believe it or not, they're not the same thing at all. And really getting that difference, that is the key to mastering this whole game. All right, let's dive in. To really get our heads around stock options, we're going to approach this like a consultant would. We need a clean framework, what we call MIS, or mutually exclusive, collectively exhaustive. So we'll start by splitting this topic into two distinct worlds. Then we'll drill down into how each one works. And finally, we'll pull it all back together so you have a complete strategic picture. So the single most important idea to grasp right from the start is this. Stock options live in two completely different, totally separate worlds. Getting these two mixed up is, without a doubt, the biggest mistake people make. So the first thing we're going to do is draw a hard line right down the middle, separating the world of trading from the world of compensation. And this slide really lays out our core framework. See, on one side, you've got your traded options. These are purely financial tools used for speculation, betting on which way a stock will go, or for hedging risk. Anyone can buy and sell them on public exchanges. But on the other side, you have employee stock options, or ESOs. And their purpose is completely different. They're a form of pay, an incentive a company gives you to align your goals with the company's long-term success. You're granted them, you don't buy them on the open market. Okay, let's drill down into that first world, the world of traded options. This is where we'll look at how these things are used out in the public markets as pretty sophisticated tools for leverage and strategy. We'll kick things off with a basic definition of what an option contract actually is. So the key phrase here, this is everything, is right, but not the obligation. You are paying for flexibility. You're buying the choice to do something without being forced to do it if things go south. That simple distinction is where all of an option's power and value comes from. Now, in this world, there are really two main flavors. First up, you have call options. A really easy way to remember this is you're betting the stock price will go up, so you want the right to call the stock over to you at a lower locked-in price. If you think a stock's about to take off, you'd buy a call. And you guessed it, on the flip side, we have put options. This is for when you think a stock's price is going to fall. You want the right to put your stock onto somebody else, making them buy it from you at a higher, pre-agreed price. So if you're feeling bearish and think a stock is going to tank, you'd buy a put. It's how you can profit when a stock goes down. So every option contract, doesn't matter if it's a call or a put, is defined by a few key ingredients that control its value and how it behaves. There are 4 critical pieces you absolutely have to know. So let's break them down. First, you've got the strike price. This is the magic number. It's the price that's locked into your contract. For a call option, you need the stock's price to fly above the strike price. For a put option, you need it to dive below the strike price. It's the benchmark that decides if your option is actually worth anything. Next up, the expiration date. In the world of traded options, time is not on your side. Every single option has a ticking clock. If your prediction about where the stock is headed doesn't happen by this date, your contract expires, and it becomes totally worthless. All that money you paid for it, gone. So how much does it cost to get in the game? That's the premium. Think of it like a non-refundable ticket for the right to make the trade. The price of that premium is based on things like the strike price, how much time is left, and how jumpy the stock is. But here's the key. It's the absolute most you can lose on the trade. And finally, there's the contract size. Now this is where the leverage comes from. One single options contract usually represents 100 shares of the stock. This means a trader can control a huge position for just a fraction of what it would cost to buy all those shares outright. It's what makes the potential gains and the potential losses so massive. Okay, that's a lot of theory. Let's make this real with an example from the source material. Let's say a trader is super bullish on NVIDIA. They think the stock, which is trading below $170, is going to pop. So they decide to buy 10 call option contracts with a strike price of $170. And here's where the numbers really tell the story of cost and leverage. The premium for one contract is listed at $16.10. But remember, one contract is for 100 shares, so the real cost is $1,610 per contract. Since our trader bought 10 contracts, they're paying a total of $16,100. And what does that get them? The right to buy 1,000 shares of NVIDIA at $170. For them to make any money, the stock has to go above their break-even point. That's the $170 strike price, plus the $16.10 premium they paid. So it has to get above $186.10. And this is just the start. Pros use a whole set of complex variables called the Greeks to manage risk, but this core idea of a leveraged bet is what it all boils down to. So that's the high-stakes, fast-moving world of trading. Now let's hit the brakes and pivot to that second, completely separate world, employee compensation. In this world, the rules, the timeline, the whole reason for being, it's totally different. This isn't about a quick trade, it's about ownership and long-term incentives. The very first concept you have to understand here is vesting, and this is the detail that trips so many people up. Unlike a traded option that you buy and own instantly, you don't get your employee stock options all at once. Nope, you have to earn them by sticking with the company over time. That process is called vesting, and let's be honest, it's designed to be a set of golden handcuffs to keep talented people from leaving. A super common vesting schedule looks something like this. On day 1, you're granted 12,000 options. But a lot of plans have what's called a 1-year cliff. And from a company's perspective, this is genius. It means if you leave before your 1-year anniversary, you get absolutely nothing. Poof, gone. But on that first anniversary, bam, a big chunk, maybe 25% vests. After that, the rest usually vests bit by bit, every month, until you're fully vested after 4 years. Okay, so let's say you've put in the time. You've stayed with the company, your options have vested, and hopefully the stock price has gone up. So, now what? The next question is all about logistics. How do you turn these options, which are really just rights on a piece of paper, into actual tangible value? The process is called exercising. It's when you finally use your right to buy the shares at your low, locked-in strike price. Now, here's where we get into some next-level thinking, because this involves both cash and taxes. Most people don't have the cash on hand to buy thousands of shares, so brokers offer cashless exercise plans. But the really strategic decision often comes down to the type of option you have, whether it's an ISO or an NSO. NSOs, or non-qualified stock options, create an immediate tax bill when you exercise, treated just like regular income. ISOs, or incentive stock options, can give you better tax treatment, but they can also trigger something nasty called the alternative minimum tax. So how and when you exercise is a huge strategic decision that really depends on your tax situation and how much you believe in the company's future. And from the company's perspective, they structure these plans differently too. You might see a fixed value plan, which gives you a consistent dollar amount of options each year. That's stable, but it can weaken the incentive. Then there's the fixed number plan, which does the exact opposite. It creates a massive link between your pay and the stock price, but it also makes your compensation really volatile. And then you have the mega grant, a huge one-time grant designed to lure in top-tier talent. It offers a massive potential payday, but it's a huge risk for everyone if the stock just goes sideways for years. So, we've taken a tour through the two very different worlds of stock options. We've seen the fast-paced trading floor and the slow burn of employee incentives. We've taken apart the contracts and the strategies. So what's the big takeaway here? How do we tie all this together? Let's synthesize it all down to 4 key principles. First, and most importantly, context is king. You have to know which world you're in, trading or compensation. Second, when it comes to trading, it is all about leverage, using a little bit of money to control a much bigger asset. Third, with employee options, the name of the game is alignment, tying your personal financial success directly to the company's success. And finally, for both worlds, you have to understand the terms. The little details, the strike price, the expiration date, the vesting cliff, they aren't just details, they determine everything. Look, this whole framework is designed to take you from being confused to being confident. So the final question here isn't really for me to answer, it's for you. Now that you see this clear line between trading and compensation, which world do you operate in? Or which one do you want to operate in? And now that you're armed with this knowledge, what's your next informed move going to be?